I will now move to inflation. Headline CPI inflation declined to an all-time low in October 2025. The faster than anticipated decline in inflation was led by correction in food prices, contrary to the usual trend witnessed during the months of September and October. Core inflation CPI remained largely contained in September-October, despite continued price pressures exerted by precious metals. Excluding gold, core inflation moderated to 2.6% in October. Overall, the decline in inflation has become more generalized. Turning to the inflation outlook, food supply prospects have improved on the back of higher kharif production, healthy rabi sowing, adequate reservoir levels, and conducive soil moisture. Barring some metals, international commodity prices are likely to moderate going forward. Overall, inflation is likely to be softer than what was projected in October, mainly on account of the fall in food prices. Considering all these factors, CPI inflation for this year is now projected at 2%, again about 0.6% downwards from our earlier outlook. Q3 is at 0.6%, and Q4 moves up to 2.9%. CPI inflation for Q1 and Q2 next year are projected at 3.9% and 4% respectively. I may, however, add that the underlying inflation pressures are even lower, as the impact of increase in price of precious metals is about 50 basis points. The risks are evenly balanced. I will now draw your attention to the external sector. India's current account deficit moderated from 2.2% of GDP in Q2 last year to 1.3%. This is a decrease of about 0.9% in Q2 this year, on account of robust services exports, which continue to do well, and strong remittances. In October 2025, merchandise exports contracted YOY, whereas merchandise imports continued to increase for the second consecutive month. This resulted in widening of the trade deficit. Healthy services exports coupled with strong remittance receipts are, however, expected to keep our current account deficit for this year modest. On the external financing side, gross FDI to India increased at a robust pace during the first half of the year. Net FDI too increased significantly due to a decline in repatriation despite a rise in outward FDI. FPI to India recorded net outflows of $0.7 billion this year so far, basis figures till December 3, primarily due to outflows in the equity segment. Flows under ECB and non-resident deposit accounts moderated as compared to last year. As on November 28, 2025, India's forex reserves stood at a healthy $686 billion. This provides robust import cover of more than 11 months. Overall, India's external sector remains resilient. We are confident of meeting our external financing requirements comfortably. I will